Let's welcome on board then Dipan Mehta and chat about what he's making of the market and various sectors in the markets. Dipan, hi, good morning. Great to have you on the show as always. Dipan, Mankind Pharma, an offering from the pharma sector after a while. Wanted to understand whether this is a subscribe or, a DHP that you're reading up on.
Yeah, good morning and thank you for having me on your show. Of course, it's a subscribe. I think the market and investors generally are very favorable towards consumer-oriented companies. And if you look at the pharma space, I think going forward, the best opportunities are going to be in the domestic market for companies which have got strong brands, distribution network, and feet on the ground to sell their branded products to the doctors, the medical representatives. And the opportunity overseas is gradually diminishing. It's getting more and more commoditized, not only in US generics market, but globally as well. So given this kind of trends and scenario, I think Mankind Pharma, which is a homegrown, largely domestic-oriented company, should be definitely subscribed to. Question is whether you will get an allotment or not because of the heavy oversubscription. But from retail investor perspective, it is a good opportunity, and perhaps you could even add some stock post listing. But from a professional investor's viewpoint, I think one needs to wait and watch for 2-3 quarters, let the valuation settle down, and then perhaps take a more informed decision.
Sure. What about the rest of the pharma pack as well, Dipan? Because while 2022 was a spree of underperformance from the pharma majors, barring, I think, a DRL and Cipla, which managed to do pretty okay. Sort of some buying interest seems to be coming back. The index is already lifted up about almost 9% from its 2023 lows. Wanted to understand whether you're scouting any opportunities here.
See, I think in pharmaceutical space, one has to be extremely selective, and even large export-oriented businesses, we are seeing a lot of variance in their performance, and some companies are doing exceptionally well depending upon their product mix and target market, and others are still languishing. And end of the day, it is a complicated industry to analyze, study, and invest in. As a thumb rule, as I said, I think we prefer domestic oriented businesses, but on the whole, I would like to remain equal to underweight within the pharma space. Maybe 1 or 2 companies which come to mind, which are the market leaders, have been solid performers like Sun Pharma. Really appreciate their strategy of moving up the value chain into specialty products. That will, make them stand apart from the rest of the crowd. And I think Divi's Lab may have seen a turnaround over there. It's exceptional manufacturing company with a very strong value proposition. And the custom synthesis business may have had a couple of soft quarters because of which we saw the correction the way we did. But the long-term prospects of that are phenomenal, and it's an India advantage company. So I think when the chips are down, you want to invest in a great long-term story, then Divi's Lab kind of meets that criteria. Apart from that, I think broadly we'd like to remain, as I said, underweight. It's a very complicated industry, and there could be a lot of volatility in earnings as well.
Okay, let's understand the technical take as well. And after a slew of underperformance that we've seen, Kunal finally seeing some sort of a comeback within the pharma names. How have you assessed these stocks on the charts, and which would be some of your top bets?
Yes, Avan. So I think Divi's Lab, of course, is one of the stocks which you recommended. Looks very attractive on the charts. In fact, on March, Feb end, when the stock actually formed a major bottom, hit that 2,800 levels, it managed to close a major gap for itself, and from those levels, it's recovered more than 10%, and in a very slow and a gradual fashion. So I think that's a sign of a recovery which could probably sustain as well as grow for Divi's Lab. That's one stock which I would be keenly bullish on. Cipla has been the other name which I think closer to 880 odd mark is where we would give a contra buy. My expectation is that maybe the worst of the selling could be behind the stock. We've seen a very sharp selling which had come back for Cipla in the last 2-3 months, where it had fallen more than 50 to 20% in a very short span of time. But I think close to that 880 mark, the stock seems to have found a major support, as well as it's gone into that fall, a price fall, as well as a time-wise correction. So that's also completed for Cipla, and that looks an attractive bet. The surprising stock from the entire large cap pharma name has actually been Dr. Reddy, because the moment the stock had broken past about the 4,350 mark, we've seen a completely different kind of a price action for Dr. Reddy. it was a very labored move for the stock. It used to move in a very slow and a gradual fashion. But the moment the stock had taken out this 4350 mark, 4400 levels, we've seen a completely stronger bout of momentum coming back into Dr. Reddy. Consecutive days of price uptrend for the stock. And I think just about last week or so, the stock saw a marginal retracement, but it managed to come back to that 4,850, 4,900 mark. So I think Dr. Reddy is also one of the other stocks which has already confirmed a breakout, which is going into a different leg of a momentum on the upside and could possibly lead the charge from the entire pharma pack in this leg of an uptrend.
All right, let's hear it out then from Pankaj Pandey, some of his top fundamental stock ideas.
So some of the names which we are liking is one of them is Kajaria with a target price of 1310. One is we expect the gas prices to be softer. See, the margin profile for this company had come down to about 12 odd percent. Typically, the margin profile is in the range of 14 to 16 odd percent. We would expect those margin profile to sort of get attained in FY24. And on top of it, we are expecting about good low double-digit kind of growth in volumes. So that is one stock which we feel that the margin recovery would be the key theme to sort of watch out for. Another stock is Mayur Uniquotors. Why we like this stock is that the management is very confident of growing from say 800 crore kind of a turnover to 1,000 odd crore next year and probably 1,100, 1,200 crore year after. It's a play on the leather segment, especially used in autos, where they derive 55% of the revenues, and the balance is coming from the footwear as a segment. So this is another company which we have been liking with a target price of 580.
Okay, those are some stock-specific ideas coming in from Pankaj Pandey. Let's take a look at what else is going to be in focus this morning. And we've highlighted as to how Tata Power as well has got some relief come by. The CERC has directed Tata Power's Mundra plant. The company has asked to comply with Section 11 provisions. So some bit of relief coming in by way of that. Tata Power is going to be another stock in focus. BEML2, the land assets are going to be listed on the exchanges today. Dipan, just wanted to understand where is it that you stand, when it comes to the entire PSU pack. And I'm going to talk about ex-banks, especially with the thrust on manufacturing now. And most of these companies fall within the PSU umbrella. Wanted to understand whether you find opportunities to buy afresh from the longer term perspective.
So I think the best space within the PSU is, of course, the defense companies and the shipbuilders. But these stocks have rallied considerably, and maybe if there's a pause or a slight correction, then they are like buy on dips. But by and large, I think they were really attractively valued on dividend yield basis and on price to earnings multiple basis as well. But now I think after the rally, they are kind of reasonably valued, but still they do have excellent earnings visibility. And these are good defensive plays as well, because in the market turmoil, I don't think that they will correct as much. So that's the best place to be in. Companies like BEML, Container Corporation, which may be on the divestment list. I think if there is a very specific diktat and they in fact do go for privatization, then that could be opening up a huge trigger for those two stocks in particular. But the track record on privatization front has not been that great, I think, except for Air India. No other company comes to mind per se. So I would say it's best to wait and watch the PSUs at this point of time. And maybe after the March results, you may have some surprises, because Jan-Feb March quarter also is exceptional for the PSU companies in terms of performance, seasonally strong quarter as well. So if you're a trader in string, then maybe the defense PSU stocks may give good returns in the short term.
Okay, that's the view coming in on some of those defense PSUs. What about Rudra, how you're tracking some of these names on the charts? Defense PSUs, the cynosure of all eyes. Do you believe that there's more steam?
Yeah, definitely some of these stocks can move up even from current level, but they have already performed so well and they have given that phenomenal return. I don't know whether from current levels can you enter and see further more upside, and can that generate additional alpha what one is looking at? But still, definitely these are stocks much better to buy on any dips, and it can be definitely held for portfolio. So one can consider these stocks on correction to buy rather than buying at current levels.
Okay. Dipan, when you think that in the short term, defense PSUs can give a bout of outperformance, Now, when Dipan Mehta is talking short term, which means he's thought through something. What is that you know we don't know? And please share.
No. Good morning, Nikunj. I don't know anything which is beyond the public domain. My sense is that this earnings season, you will see the entire capital goods manufacturing space really flower, and they should come out with exceptional results. It's easily a strong quarter, and operating leverages also will come into play. The order booking also will be at all-time highs, and the execution also typically because of year end, these companies tend to speed up execution and generate more and more billing. So I would say that in the entire 30, 40 years I've been tracking the market, this would be the exceptionally great period for capital goods. And PSU defense stocks are in the nature of capital goods companies as well, except that they have a very specific kind of a product profile. So keeping that in mind, I'm very positive on that entire space, right from Larsen & Toubro, ITD, NCC, you name it. I think even ABB, Siemens, Thermax, all of these companies should report great results. There's always a bit of a kind of discussion on the price to earnings multiple and sustainability. But there's one trend across the board which I'm observing is that a lot of these orders which have come in the last 1 or 2 years, which are being under execution for the entire industry and L&T in particular, have come at decent margin profiles as well. So I expect the entire industry's ROEs also to improve, and that may perhaps give space for a better discounting. And what we like the best, of course, is the earnings visibility. And in a low to flat commodity scenario, these companies should be able to manage their operating profit margins very well as well. So that's one space where we have got our eyes completely focused on.
Interesting. GQG Partner have increased their stake in ITC from 1.2% to 1.4%. Now, GQG Partner has been an old India hand, but the name now resonates because they came out and they invested about 1.3 or 1.4 billion dollars into Adani group of stocks. Since we are with ITC, the 52-week change for ITC is 53%. Exactly a year ago, the narrative was it is in tobacco. The narrative was it's a challenging business because global funds will not buy into tobacco companies because of ESG restrictions. But guess what? If you look at the so-called labeled anti-ESG or the non-ESG compliant stocks, NTPC, Tata Power and ITC, they've given perhaps the best returns. Tata Power last 1 year, NTPC last 1 year, ITC last 1 year, and you will actually see that the returns Tata Power is not given actually. But NTPC is given good returns and ITC surely is given good returns. Depend on a traditional PE yardstick, ITC still looks cheap. It's nowhere close to the kind of P multiple, let's say, Asian Paints, Nestle or HUL is commanding. Is that the right way of looking at ITC? Because it still has a long way to go despite a 50% up move.
See, Nikunj, I got ITC wrong. I was negative on the stock right from last several years or so. And of course, we and our clients missed out on this superb rally. The logic was very simple that tobacco consumption was in low single-digit volume growth rates. Their FMCG business also, although it had generated a lot of volume, but if you compare their FMCG business in terms of operating profit margins, return on capital employed, any of such other financial metrics, it was poorly compared to some of the larger homegrown FMCG companies as well. And apart from that, they have the hotel business where there's a high degree of volatility. And clearly, according to us, the opportunity was if they were to split the three businesses separately, but I don't think that's on the cards at this point of time. And despite all the last 30, 40-year effort of the management to diversify away from tobacco, that's just not happened. I mean, tobacco still is like 90% plus in terms of profits for the company. So looking at the full picture, we didn't think that the stock would generate sustainable long-term returns. But I think, it was a value play. And as you said, I think, when there's an opportunity that certainly outweighs any environmental or health concerns that investors may have. And it was a great dividend yield also at that point of time. And we are this rally. But the question in my mind is that is this like a kind of a one-time adjustment? Because going forward, I think next 2-3 years, again, if the profits start to flatten out, then again, you may have underperformance in the stock. So that's my assessment. But as I said, I've got it wrong in ITC so far, so please take my opinion with a pinch of salt.
Okay, fair enough. Let's hear it out then from some of our other guests. What are their top fundamental stock ideas? We keep that going. So here's Neeraj Diwan. What's he betting on? Take a look.
Yeah, the stock I want to recommend today is KRBL. So they are one of the largest millers and basmati rice exporters. So recently we've seen a good build-up in inventory. The company procured 47% more paddy this year, and even the price has gone up by 15%. So the company, which is expanding into regional rice also, has announced a capex of about 250 crores approximately to be spent over next 2 years for increase in capacity of regional rice, which sells as a premium to the normal rice in the market. So the expansion in the margin will happen because of improvement in the price of the basmati that we've seen. Plus the growth will come because of increased inventory in basmati and the regional rice capacity which will come from this year and increase in the next couple of years. And plus the company has a Saudi business which was hit earlier because the dealer was not there. So they've not wanted a new dealer. So there's improvement in business from Saudi. Plus the company is even looking at appointing another dealer in Saudi. So there will be even continued improvement from the Saudi business. So all this together will translate into a top line growth of 20 to 23% over the next 2-3 years, plus improvement in margin that we're already seeing should continue over 22 to 24, about 470 basis points. So if I value this company at 11 times 1 year forward, I get a target of 415, which is the return of for 20% plus over the next 1 year. So I recommend this for investment for medium to short term.
I just want to revisit the story which erupted in the afternoon yesterday and then got dismissed in India or reported during the market hour, which is that government is looking at revisiting the entire tax structure for capital gains. The story erupted, a global media reported it. 3 o'clock we went on air and we said, look, it's nothing of that is happening. And now there's a clarification which has come from the income tax department. It's there on the website and on the Twitter handle that there are no plans to revisit capital gains tax. And frankly, you think about it logically, if any changes had to be done, they would have been changed in the finance bill. It's not that changes have not been done in the finance bill. We know for the debt mutual fund industry, it's changed. Next year is going to be vote on account. And since it's going to be that general election year, which is 2024, next year's budget will not see any large tax changes as per the law because it's a vote on account. So from a market standpoint now, at least you pretty much know that long-term taxes will not be changed for a good 1 year plus. So that in a sense is a mighty relief for the market standpoint. So Dipan, I look at it logically. For all the concerns which keep on erupting about the taxation structure for long-term and short-term will change. If I put two and two together, next budget is going to be vote on account, which will not see tax changes. Then there is a general election cycle. Then there is a budget after that. So looks like all the naysayers who've been talking about the tax structure which could change in short-term and long-term, they need to just take it easy now.
Yeah, absolutely, Nukuj. I think you need to keep to rest this argument, this news flow which keeps coming. One of the best things that the finance minister has done is given us stability in tax structure. I mean, whether it's corporate tax or personal income tax or even capital gains, the rates have come down, but there have been no major changes. And that really is very important in terms of planning people's business operations or savings for that matter. And now that everybody's going to the new income tax regime, we are going to see more and more money flow into perhaps equities and mutual funds, and there is no real reason to invest in PPF and Provident Fund and some of the other government saving schemes. So keeping that in mind, I think why would you disturb the capital gain structure? You are getting solid revenues from STT as well, and that those rates also have increased. So I think we are pretty much stable when it comes to the tax structure. And every passing budget, the focus has been more on expenditure planning rather than tinkering with the taxes. And that I think has been the highlight of the Modi government. And we really, appreciate that kind of an approach. So I think they should be out of the discussion boards for a long, long time.
Okay, just taking note of some of the flashes as well, sources on SCI, that's Shipping Corporation as well, talking about how the government is going to speed up the SCI divestment process. They are going to list the land asset company of SCI, and the financial bids can be invited in the months of May and June. This, remember, on the heels of the fact that you have the divestment of the land assets of BEML. Remember, today BEML land assets is going to be listed on the exchange. This is the non-operational surplus land, close to 1,500 acres that the company holds. And the total resaleable value of this excess land is seen between 3,000 to 4,400 crore rupees. So we'll be keeping an eye on some of these PSUs in light of that. Dipan, we got your take on that basket as a whole, but also curious as to where you stand when it comes to, the likes of Policy Bazaar, Zomato, some of these other new age tech companies. Just today you have the IRDAI guidelines on expensive management with some clarity needed, a PB FinTech talking about that. Any views on the same or these companies in specific?
See, I think these companies are generally going as per plan, and their focus is now to turn profitable much faster and earlier than they earlier anticipated. It's the demand of the investors that these companies start to generate profits, and then we can start valuing them based on traditional valuation parameters like price to earnings, price to book. And I think they are clearly on that path. They have adequate cash on their books, which is perhaps a comfort for many investors. And genuinely new age businesses. A few of these will be really large companies in the 2030s decade. And if you have invested early in them, they could turn out to be fabulous multi-baggers as well. They are going about changing habits, changing consumption patterns, and they are themselves, large players or dominant players within the industry. And gradually they are creating a stronger and stronger moat for themselves. So our strategy is to buy them somewhat like options, have a little bit of exposure, 5-10% of your portfolio in such new age businesses. And let's not try and assess them or look at them every quarter, but give them a longer runway and remain invested and see how they are actually progressing. So we're generally positive, but as I said, I think you need to have a really long-term temperament for these companies and not get impacted by a lot of volatility which is there in their stock prices and maybe their earnings as well.
Okay, just let's get in a take then on some of the mid-cap as well as large-cap IT companies on the charts. Given the rough few days that we've seen, although we did see some short covering yesterday, Rudra, what's your view on LTI Mindtree, Infosys, Zensar Tech, etc.?
See, I will avoid them even for some more time, might be another quarter, and then look at whether on charts I see that bottom formation and then try to catch. I don't want to pick a falling knife, but however, there are exceptions even in this mid-cap IT. I like stocks like Onward Technology. This has been one stock I have been following for a long time. I and my clients definitely have positions in the same from levels as low as 70 rupee. But even at current levels, if you see the chart pattern, last 1 week, again, this stock has held the strong bottom at around 290 zone, and again, it is bouncing back. So Onward Technology is one stock which is headed towards levels of around 450, 500, might be in a year or two, a good stock to own in portfolio, and it has performed exceptionally well, irrespective of IT as a sector, which has not done very well. But I feel right now, even if you pick up the larger ones like Infosys, TCS and all, they have come at attractive valuations, and I won't be surprised from here. You may not find much downside, might be another 5-10% kind of a max move on the downside. These are times to now start slowly picking into IT as a sector, and you have to be very stock specific in it and see where you have comfort in terms of both valuation and even stock wise. You see the chart patterns where you have that bottom formation and then buy. Infosys for me might be another 5-10% down from current level, looks very attractive. And from mid cap, I like Onward Technology, and even few stocks like Persistent System, for example, looks very strong on chart. I will definitely look at buying even Persistent. So you have to be very choosy, stock specific, but now definitely you don't have any opportunity to go short in IT at current level. It is time to wait out for that 5-10% kind of a dip and start accumulating now and buy on that 5-10% dip more.
All right, let's just address then some of that news flow that we were getting a short while ago. The sources speaking on SCI speeding up the divestment process. It's an ET Now exclusive, and my colleague Prakash Priyadarshi joins in with all those details. Prakash, what exactly are you picking up?
Yeah, sources are informing that government will speed up the divestment process of SCI from next month, and the listing process of SCI's non-core business will be initiated by early next month. Sources are informing that the land asset company of SCI will be listed, and the examination process is underway at the moment. And the government will initiate process after the listing of BEML's non-core business. So it will be priority for the government BEML's non-core business listing, and the divestment process of SCI will be initiated from next month. Apart from that, sources are also informing that the financial bids for SCI will be invited by in the last week of May or in the month of June, and the government is also hoping to complete this whole divestment process by end of this year. So it's a big development, and we can only hope that the government will initiate the divestment process by next month as far as the SCI divestment is concerned. To you.
Prakash, thanks a lot for that. IDBI Bank and SCI. For SCI, look, the financial demerger will only happen when the real estate is separated. And for IDBI Bank, things are at least moving in the same right direction, because now we understand that there are more and more bidders who actually are interested in buying for IDBI Bank. I mean, for the real auction process to go through, it cannot be done in isolation. So you really need to have a real scenario which perhaps will make the divestment process very easy. Dipan, whatever is said and done, when LIC was not getting listed, everybody said, okay, government is going slow on reform. They are not able to list LIC. When LIC got listed, it was very nicely priced. Everyone said that, look, this is a issue which is leaving a lot on table. But it's nowhere close to its listing price.
Yeah, that really is an enigma. And it's partly to do, I think, and it's my personal view, it's partly to do with the fact that LIC doesn't disclose its adjusted value in a timely basis. And that makes it very difficult to analyze, point number one. Point number two, I think it's very sensitive to stock price movements, much more than any other insurance companies. And since listing, I think we have seen the overall market trends to be on a declining mode as well. And that also has impacted the sentiment in LIC. And on the whole, I think insurance companies also have underperformed for various reasons, call it high base effect, call it competition, regulatory reasons, so on and so forth. So all of this, I think, has resulted in LIC underperforming. But don't write off this stock. I think it's a solid player. And at some point of time, once they start getting some of the more profitable products going and scaling up, you may see exceptional numbers coming through from LIC as well. Despite so many new players, they've been able to hold ground, maintain their market share. And as such, it is quite a well-run, well-managed company as well. And who knows, I mean, we had written off PSU banks and PSU capital goods manufacturing companies and defense companies 2-3 years ago, and see what kind of returns they have given. So why not give LIC a chance as well?
Give LIC a chance. Dipan, good to have you on board. Thanks so much for joining in with your take.